When it comes to financing residential real estate, most transactions follow a familiar process. When a seller finds a willing buyer with the required income, employment history, credit score to qualify for a mortgage, a lending institution puts up the money to actually finance the deal. But what if traditional financing isn't available and the buyer and seller still want to proceed privately with the sale? We then enter what's known as seller financing. As the term implies, the person who is selling the house actually finances the property for the buyer. In this video, I'm going to break down how seller financing works, some advantages to seller financing, and what you'll actually need to structure a deal like this. Hey, what's up, my sexy McMuffins? Tyson Dela Cruz here. Thank you so much for joining me. In my experience, seller finance transactions can actually be a lot quicker and cheaper than the conventional ways of purchasing properties. First, the buyer needs to confirm the seller is free to finance the actual asset, that there's no existing mortgage on the property. If there's an existing mortgage on the property, we would have to do something called a subject to transaction. And that, my friends, is an entirely different video. In a seller finance transaction, the bank actually isn't involved at all. The buyer and seller actually make an agreement amongst themselves. They draw up a document setting out the interest rate, schedule of payments from buyer to seller, and the consequences should the buyer default on their obligations. Unlike the sale involving a mortgage, there's no transfer of principal from buyer to seller, but merely an agreement repaying that sum over the course of time. With only two main players involved, owner financing can be a lot quicker, cheaper than selling a home the customary way. There's no waiting for the bank, loan officer, underwriter, and legal department. The buyer can often get into a home for less money and freaking a lot quicker. This alternative to traditional financing can be useful in certain situations in a place where mortgages are actually kind of hard to get, or somebody can't qualify for a mortgage at the moment. In tight conditions, seller financing provides the buyer access to an alternative form of credit. Sellers, in turn, can usually sell the property a lot faster without having to do those costly repairs that lenders typically require. Also, because the seller is financing the sale of the property, the seller may actually command a higher sale price than what the current market value is. Closing costs are indeed lower for seller financing sales. Without a bank participating in the transaction, this avoids the cost of the mortgage, the discount points, as well as origination fees, and a host of other charges that lenders routinely extract during the financing process. There is also greater flexibility about the loan provisions, from the required down payment and the interest rate to the terms of the actual agreement. The seller's financing typically runs for a short period of time, anywhere from 3 to 5 years, with a balloon payment coming due at the end of that period. The theory, or hope at least, is that the buyer will eventually refinance the property with a traditional lender, armed with the improved credit worthiness and having accumulated some equity in the home that they purchased. Seller financing. Now, before you go and pitch every single lead that you have in your database seller financing options, homeowners offer seller financing often openly announce the fact and hope to attract a buyer who typically doesn't qualify for a traditional mortgage. A lot of this data can typically be found on your local MLS. If you don't see a mention of seller financing though, it doesn't hurt to actually inquire. However, instead of asking if owner financing is an option, you might need to present this specific proposal in a manner that entices the seller. Some sellers are not looking for a lump sum of money when they sell their assets. Some sellers are actually interested in monthly income. Say something, for example, Mr. or Mrs. Seller, if I'm able to get you full price or above ask with 15% down and reoccurring monthly payments over the next 5 years, a lump sum due on that 5th year, would that be something that would interest you? Next, you gotta confirm that the seller is free to actually finance the sale of the property. Seller financing is simplest when the seller owns the property outright, when the property is free and clear. Paying for a title search on the property will confirm it's accurately described in the deed and it's free and clear of any mortgage or tax liens. So how do you structure a seller financing deal? Both parties in a seller financing deal should hire a real estate attorney to write and review the sales contracts. And something else you'll need is something called a promissory note. The promissory note outlines the terms of the agreement, such as the down payment, monthly payment, interest payments, when the balloon payment is due, and other terms you and the seller agree upon. When searching for an attorney, try to find a professional who's experienced in seller financing home transactions and who also have experience where you live, if possible, because some relevant regulations, such as those that govern balloon payments, do vary from state to state. Seller financing is an amazing tool to have in your real estate investing tool belt. As unusual and unfamiliar as it is to most people, seller financing can be a helpful option in a challenging real estate market. Guys, if you enjoyed this video, go ahead and smash that like button down below. As always, be kind, rewind. Peace. The best part of waking up is fingers in your